Hello and welcome to CryptoWeeklies. My name is Josh, and today in this video we are going to discuss about Multiverse X, which is a blockchain protocol, one of the top 100 cryptos by market cap. We will be first of all analyzing its relative valuation, also conducting AI-based forecast and regression analysis. So let's get started. What is Multiverse X? It is one of the top 100 cryptos by market cap. Currently market cap slightly above 1 billion. And circulating supply at around 86%. The tokenomics is 27 million tokens are in circulation. Max supply at around 31 million. So about 87% of tokens are in circulation. Which again per volume, the decent volume at around 108th position. Fully diluted market cap at around 1.1 billion. So what makes Multiverse X unique is that it offers high scalability through its unique sharding technology, capable of processing up to 100,000 transactions per second. It aims to support the new internet economy, including decentralized finance and the metaverse. The EGLD is the native token of the blockchain used for network transactions, staking, and governance. This particular crypto is founded in 2017. And it focuses on solving blockchain scalability issues. It employs proof of stake, consensus algorithm, and supports smart contracts and dApp development. So that's a little bit about eGold. In terms of analyzing where the relative valuation of eGold is, we'll go back to our website cryptoweeklies.com. All of the content on this website is freely available. You don't have to pay or sign up for anything. You can follow along on this website by referring to the link on the bottom of your screen. We'll start with the AI-based forecast. Now that we know that the price has rallied some by the last 7 days, from about $28 to about $37. In terms of, this is the weekly average price of eGold starting September 2020, and this we fed this price and trained our AI model on this weekly price action and asked the model to provide one standard deviation confidence bull case, bear case, and base case. That means about 70% what are the theoretical going forward ceilings where you would meet resistance, as well as what are theoretical trailing supports where we will have some support again at floor level. So if the per the AI based model, if there is no major bullish or bearish event, the base case scenario for eGold now going forward till about end of November to early to mid December is price action between $38 to $48. In terms of if there were a rally back to the upside in the market, as well as eGold participating in that rally, the one standard deviation bull case is between $44 and $141. So I would like to share the disclaimer that none of the content that we discuss on the channel is financial advice. We use machine learning, statistics, and data science technique to look at the relative valuation, as well as conduct AI based forecast based on the historical data. In terms of how low can eGold go if there were a further slump in the market, the one standard deviation support between now and December is between $13 and about $33. And if you are interested in knowing the week by week support and resistance level going forward, and also the AI based forecast, you can also check out in a tabular way on this website. In terms of now looking at the regression analysis, where do we stand? The price action, this is the these are the polynomial regression function wrapped around the weekly price action for eGold, and the fair value is the line in the middle, that is pink line. And if we get rid of some of the standard deviation, so each of the band to the upside is one standard deviation increment to either to the upside and to the downside. Yellow is one standard deviation up, orange is 2 standard deviation up, and red is 3 standard deviation up. So the key idea is with one standard deviation you get about 70% of the market cycle, price action covered in those bands. If we add 2 standard deviation band, you would get about 95% of the price action is within these 2 standard deviation intervals. Right now the price action, the fair value is at around $42. Price action slightly below this. One standard deviation floor which we tested back in early June of 2024, that level is at around $29. So the key level to watch is, first is $42. If it breaks that $42.91, then the second level is $63. That is the one standard deviation peak, and the two standard deviation peak for EGLD at this point in time is $93. And if you were to go back to the AI model, as it suggested that the theoretical upside, the three standard deviation level is at around $140, which is very close to the AI model where this forecasted at around $141 in December. So again, this is again some confluence in terms of analyzing the price with respect to simple moving average and color coding the risk as a normalized measure between the price and the simple moving average. Right now the risk level is at around 0.3. This means in terms of where we lie, most of the time is spent on this between the band between 0.2 and 0.3 risk. When the risk levels are and in this particular band, there were some decent buying up opportunities in October, November 2023, but again the best time per this analysis is actually between 0.0 and 0.1, which tends to be not close to the bottom, because what we have seen is that when the price and when there is a maximum difference between price and the simple moving average, it is not actually near the bottom but actually close to the maximum drawdown for that particular crypto, that is during the middle of the bear market. So this is again one of the models to judge, but again this model also works in confluence with the DCA model, which takes into consideration not just the difference between price and the simple moving average, but considers the regression, the difference between the price and the regression fair value regression price. For this analysis, the risk level is at around 0.13. Again, the great time to buy is between, again not financial advice, when the risk is between 0 and 0.1. You can see that this particular model does a fair job of analyzing, a better job of analyzing what is a great time to dollar cost average or dollar cost average out of the market when the risk levels are high. For example, over here when the risk levels were at around 0.53 over here, the key idea is when the price moves out of these peak regression bands, those are some of the key levels to watch. If you want to look at the future, extend it a bit into the future, because of the shape of the regression function has a downward shape, the future regression band at this point of time is pointing to a decline. So again, this is also one of the key caveat. You can see that in the last rally, when the price was at around $72, it kind of touched the peak regression band, but in the mania phases, this 2 standard deviation peak regression band is taken out, but we are that level is at around $85 right now. We are very close to that level. So this is all about EGLD. Just to summarize, per the DCA analysis, the price, the risk level is at around 0.13, decent time to DCA. Per the SMA, again at 0.3 risk. In terms of the AI based forecast, the base case is between $38, $48, the bull case between $44 and $146, the bear case between $13 and $33 for EGLD. Now we'll just briefly spend some time to analyze what has happened in the wider crypto market. These are some of the popular narratives over the last 24 hours. Most of them are bullish, a couple of bearish ones. Overall sentiments over at around 84 in the crypto market. In terms of the PeakValley risk, which is a normalized risk between 0 and 1 based on the price action of top 100 cryptos by market cap. You can see what goes on in this calculation using the link on the bottom of your screen. We are currently in the low risk territory. You can see have been in this regimen since early July of 2024. We can also zoom it over here to see what has been the trend from 0.38 risk now at 0.17 risk. the risk levels are declining, and again when the color codes are green or blue, that's when historically speaking DCAing in the market is beneficial. And when the color codes are orange and red, especially when they're red, that's when DCAing out of the market is has been proven beneficial, personally speaking. And the corresponding risk score for the color to be red is between 0.75 and 1. Right now the risk is at 0.17, so quite a fair distance from here. In terms of the narratives which are gaining some popularity in the market over the last 7 days, Bitcoin definitely being discussed a lot, followed by the bullishness in the market. Trading is back because of the sideways action. Also narratives related to Ethereum are gaining some popularity. People are talking about selling, and this is all of the narratives discussed related to crypto on YouTube. Solana, one of the other major narratives. Bearishness is also a popular narrative, but it is not as a big of a narrative as bullish narratives. Or price action is being discussed. Government related regulations are being discussed. So this is one single snapshot. And in terms of if you were to summarize what is going on in the market, this SMA risk normalized between 0 and 1 gives an idea of what is happening to with Bitcoins and Ether's price action, and normalized between 0 and 1 the risk associated with the market in terms of the short-term bubble. The Bitcoin is at around 0.2 risk level for its price action with respect to 20 weeks simple moving average, as well as Ether is at around 0.31 risk level. So the key idea with this, what I have seen, is that when the Bitcoin risk is lower than Ether risk, that is a time where DCAing Bitcoin is beneficial more than DCAing altcoins. For example, in July of 2021, where the Bitcoin had a major slump, and also right now when Ether risk is slightly higher than Bitcoin, that is again pointing to a favorable territory for Bitcoin. So with this, I would like to conclude the video. Hope you like this content. If you did, please subscribe to the channel. Also give this video a like, and hope to see you again tomorrow. Thank you and have a nice day. Bye bye.